Welcome, everyone. If you're in the C-suite, this explainer is built specifically for you. We're looking at a fundamental shift happening right now as we head into 2026. The days of the chief financial officer just sitting in a back room keeping the books, completely over. Today, we're tracking the critical evolution from the traditional controller to what we call the modern capital orchestrator. And honestly, this shift directly dictates whether your organization thrives or barely survives.
PwC really hit the nail on the head here. They noted that CFOs are stepping into 2026 as enterprise strategists and architects of reinvention. And they're absolutely right. These stakes are just too high now. Playing it safe with passive accounting isn't just outdated anymore. It's a literal corporate liability. Modern finance leaders have to step up and proactively architect true enterprise value. You've got to bridge that gap between raw data and long-term strategic resilience. Because if you aren't reinventing, you're already falling behind.
So, here is our transformation blueprint for today. We'll start with the rise of capital orchestrators, move into strategic planning and M&A, explore redefining modern risk management, cover hedging against market volatility, and conclude with data-driven capital allocation.
Section 1. The rise of capital orchestrators, the paradigm shift.
Okay, let's dive into this. For decades, the CFO was often seen as the corporate fund police, right? Just guarding static budgets and crunching historical numbers. That era is done. Today's modern capital orchestrator focuses on forward-looking insight and active value creation. We're talking about driving dynamic ecosystems where insurers, reinsurers, and investors are actually co-creating value. But to pull this off, you need a very unique dual mindset. You basically need to combine the rigorous, process-driven brain of an engineer with the persuasive communication skills of a preacher.
And when you actually link finance directly to your overarching strategy, the results are incredible. Let's look at a leading global insurer that recently overhauled its finance function to architect value rather than just passively measure it. By seamlessly aligning finance with strategy, technology, and talent, they managed to slash the entire cost of their finance function to a mere 0.55% of company revenue. That put them squarely in the top quartile for global operational efficiency. That is a massive competitive advantage.
Section 2. Strategic planning and M&A, the growth engine. So how exactly does this modernized CFO drive that kind of corporate growth? Well, looking at Deloitte's 2026 outlook, it really comes down to targeted discipline. Insurers are preparing for opportunity, not volume. The current M&A environment isn't about an urgent surge of buying up everything in sight just to artificially pump up revenue. It's highly targeted. It's all about profitable strategic growth. The CFO Guidebook actually outlines the core acquisition strategies driving the smartest deals in 2026. First up is synergy, methodically stripping out overlapping costs and boosting revenue between similar businesses. Then you have accretive acquisitions, which is essentially absorbing smaller targets to slowly build sales while eliminating future competitors. Third is the market window strategy. This is about capturing those brief, fleeting openings by acquiring a company that's already perfectly positioned with the exact distribution channels you need. And finally, vertical integration, where you're buying up the supply chain to assert complete control. But listen, the CFO's absolutely crucial role in all of this is validation. They have to rigorously stress test these moves through deep SWOT analysis, analyzing strengths, weaknesses, opportunities, and threats to ensure the strategy generates actual, sustainable shareholder value. But that brings us to a really critical question for anyone in the C-suite right now. We all know how to allocate capital for growth, sure. But in a world of complex regulatory shifts, negative rates, and insane market volatility, how do we actually protect it?
Section 3. Redefining modern risk management, the protective shield.
What we're seeing is a massive transition from traditional passive oversight to active risk quantification. The CFO Guidebook lays out this brilliant, clean, 3-step executive framework. Step 1 is risk identification, basically mapping out every potential threat, from cyber vulnerabilities all the way to supply chain disruptions. Step 2 is risk quantification. This is where you move beyond just a narrative and actually assign hard financial costs and probabilities to those events. And step 3 is risk ranking, plotting these risks on a grid based on frequency versus severity. What this does is take a dense, somewhat theoretical concept and turn it into a clear, actionable plan so the C-suite can allocate protective resources exactly where they're needed most.
Section 4. Hedging against market volatility, advanced protective mechanisms.
Now, what's really interesting here is the sheer elegance of the financial engineering available to manage this volatility. Take the cylinder option. This is a highly effective hedge where a company simultaneously purchases a cap and sells a floor. The beauty of this mechanism is that the gain from potentially exercising one option partially offsets the cost of the other one. It is an incredibly cost-effective way for global companies to survive and manage extreme interest rate or foreign currency fluctuations. You're locking in stability, but without paying those exorbitant upfront premiums. Surviving extreme short-term fluctuations is only half the battle, though. Managing the long-term horizon requires asset liability matching, or ALM. Basically, this is constructing your investment portfolio so that your asset inflows perfectly replicate the precise timing and amounts of your expected liability outflows. If you're in the life insurance sector, this is absolutely non-negotiable. You are making long-term guarantees to policyholders, and those obligations are under constant threat from volatile discount rates and shifting market realities, especially under frameworks like IFRS 17. A modern CFO has to master ALM to guarantee that when a claim is filed decades from now, the liquidity is sitting right there waiting for it.
Section 5, Data-Driven Capital Allocation, the Future Vision. Capital allocation definitely isn't a one-size-fits-all game anymore. In life and annuities, the allocation focus is intensely on that asset liability matching we just talked about, plus navigating IFRS 17 and optimizing annuity pricing. But pivot over to property and casualty, and the focus shifts entirely to dynamic pricing models, battling claims inflation, and managing reinsurance strategies. As a modern CFO, you have to arm your executive board with highly specific strategies that tackle the unique pressures of their exact divisions.
If you need tangible proof of how powerful this kind of strategic allocation can be, how about 1 billion euros? That is the massive capital release a global insurance company pulled off simply by implementing a quota share reinsurance mechanism for its French property and casualty business. By smartly ceding a fixed percentage of premiums and losses over to a reinsurer, they smoothed out their earnings volatility and instantly freed up 1 billion euros of trapped capital to use for new strategic investments.
And this brilliantly illustrates how data-led allocation delivers massive bottom-line uplifts too. Think about a 5% increase in return on equity. A leading Swiss insurer generated this massive 5% ROE boost over just 3 years simply by utilizing dynamic portfolio steering. Instead of leaning on outdated static budget planning, they used their risk appetite framework to constantly assess risk-adjusted returns across all their business lines. That allowed them to rapidly reallocate capital straight to the most productive areas. So how are they executing these pivots so incredibly fast? 2 words: agentic AI. Deploying AI into the finance function provides the ultimate speed and visibility you need for modern capital allocation. We're seeing up to 40% better forecasting accuracy out there. Autonomous invoice matching is cutting cycle times by a staggering 80%. And perhaps the biggest game changer for the C-suite? Real-time scenario planning. Your finance team is no longer bogged down in manual reconciliation. Instead, they're running live simulations of market shifts, which enables you to pivot capital instantly with absolute confidence.
Which really leaves just one critical question for every executive tuning into this explainer today. Is your finance function merely keeping score, or is it actively orchestrating the future value of your enterprise? The blueprint for risk mitigation and intelligent growth is crystal clear. It is time to build the financial engine of 2026.